We're now going to look at an exam standard question that focuses on a number of working capital issues. To begin with, all I want to do is to look at the working capital question with regard to the overtrading question. To give you a big picture view, of course you can't see the detail here, the question's called Uden here. We're given an income statement and we're given a balance sheet. And based on that, we have our requirements. So whatever happens, yes, there is the full amount of detail here, but what we're going to end up seeing is just few numbers here and there as we need them. Now, that being the case, let's zoom in and see what's what. If we're looking at our requirement here, please read it. Identify the reasons for the sharp decline in Uden's liquidity and assess the extent to which the company can be said to be exhibiting the problems of overtrading. What's the most important word in the whole of that requirement? Well, given that I have 13 marks, the issue with any of these questions is that we want to break it down. And so to me, by far the most important word is this one here, and. Because as soon as I see the word and, I immediately think instead of one question, I've got two questions. That must make life a lot easier. So, what's the first question? Oh, identify the reasons for the sharp decline in Uden's liquidity. Well, it's a question I ask many times of my wife. Where has all the money gone? So, that's one question. Where has the money gone? Why is it we've run out of cash? The second one is assess the extent to which the company can be said to be exhibiting the problem of overtrading. Interesting this. If you look at the requirement, it says assess. I suppose that means measure, doesn't it? So we want to decide, are we overtrading or not? So, of course, these two questions are linked. But my view is that they are wholly separate in every way. On the one hand, where's the money gone? On the other hand, are we overtrading? And if you don't separate them out, you're only going to get so many marks. So shall we look at the first one first? Reasons for the sharp decline in Uden's liquidity. To do that, I suppose what we have to do is to go through the financial statements. Let's start with our balance sheet. Slightly old-fashioned format, reflecting the fact that, yes, this goes back a number of years. Having said that, it's a very healthy question, regardless, and exactly the level that you would expect. A pointer here. This question has been almost repeated verbatim in some ways by your examiner. Right, fixed assets. In X2, the previous year, 9 million. Now, 12 million. I think we've now seen one area where the money has gone. Please note, fixed assets net. So the investment in fixed assets is not 3 million. Because we have the net figure here, presumably that's the net book value. We would have expected some depreciation, wouldn't we? So the overall investment in fixed assets is 3 million plus whatever depreciation was charged during the year. Wow, one good place. Where else have we put the money? Well, I suppose, yes, there's been an increase in stock. And yes, there's been an increase in debtors, what you and I now know as receivables. So hold on a moment, before we get too far on this one, we've got what? Plus 3 million there. We've got plus 0.8 million there, and we've got plus 1 million there. So three very obvious things to say before we go any further. I would say, if you wanted to, you could have looked at the operating cycle here. There's no issue there. I've decided not to. Do we want to comment on cash? Well, note, we're asked for the reasons for the sharp decline in liquidity. All we see with cash is that there has been a decline. So really, we can't talk about that. Moving on. Is there anything else we could take from the balance sheet? Well, please note, one reason for the sharp decline in liquidity could be because we've got no new funding. So if we look at the bottom, we notice that we have some long-term debt. And long-term debt has not changed in any way. To me, that's worth a comment, because it suggests, yeah, we've spent lots of money here, there and everywhere, but we haven't replenished it in any way. And if we look at our share capital, the ordinary share capital remains the same as it was before. So hold on, how many things have we got here? We've got 1, 2, 3, 4. We talk about investment in fixed assets, investment in stock or inventory, investment in receivables, and no new funding, no new share capital, no new debt. Is there anything else that we could take? Well, further up, we have our income statement. If we look at our income statement, I would guess that there is not much that we can say about cost of sales on the basis that we, as financial managers, have nothing to do with the operating costs. Likewise, there's not much we can say about interest, because we are obliged to pay interest whether we like it or not. And again, there's not much we can say about tax, because I'm inclined to argue that we must pay our tax as it falls due. Something slightly ethical about that. But what do we notice here? Don't we notice that a very high level of dividend is being paid? And given that, well, if we look at the top here, sales are growing quickly, therefore there is probably pressure on the need for cash. Isn't that a fairly foolish thing for the company to be doing? Now, I know we may be looking to maintain a level of dividend, to be consistent from year to year. But looking at all of the other numbers here, I'm suggesting that the level of dividend is high. High in relation to the profit, and it's also increasing quite dramatically. So, to recap, we would have to make a comment with regard to non-current assets, inventory, receivables, permanent funding not changing, and finally, that we have this discretionary cost, dividend, cash outflow, which is very high. 5 things to say, 5 solid comments. We should be scoring some solid marks in this area. I've looked at that part of the question. No problem. It's important, very, very important in this particular example. But the question I'm more interested in is not that. What we want to look at is, does this company exhibit overtrading problems? So let's go back and remind ourselves of what those overtrading problems are. Well, okay, so if we are looking to assess whether we're overtrading or not, remember, it's always the same sort of things that we look at. First of all, our liquidity ratios. Secondly, our cash balance. Thirdly, our payable days. We may look at other things as well, but those are the core. As such, we've got a focused answer, and our focused answer will be good. So, looking back at the question, shall we start with our liquidity ratios? If we're looking at our liquidity ratios, we know that the current ratio is where we look at current assets divided through by current liabilities. In this example, what do we have? Well, we have current assets. We have current liabilities. That will give us our current ratio. Of course, when we come to look at the quick ratio, we have to introduce inventory or stock as well. So let's go away and see how we go about this. we're looking at Uden. And my suggestion to you is that if you're ever expecting to do quite a lot of analysis, lay it out in a manner that the examiner can easily see the numbers. So first of all, we want to look at the liquidity ratios. Firstly, we're going to look at the current ratio. Current ratio is current assets to current liabilities. Very straightforward. If we look at the values, I suppose everything here is in thousands. The current assets in 20x2 were 4.5. Current liabilities were 2. 20x3, 4.9 million and 2.4 million. We have a value of 2.25. Some of you may be inclined to write 2.25 to 1. No issue there. And 2.04. So, we have our current ratio. No problem. We'll make a comment about it in a moment. Then we want our quick ratio. If we're looking at the quick ratio, it's current assets minus stock, or if you wish, inventory over current liabilities. So we've got the values above, might as well use those first. 4.5 million over 2 million and 4.9 million over 2.4 million. But what we want to do is to offset our stock or our inventory. To do that, let's go and find what that is. We have here 1.4 and 2.2 million. Not a problem. 1.4 and 2.2 million. Therefore, we end up with 1.55 and 1.13. Now, the question is this good or is this bad? You know that when it comes to ratios, we really want to compare this to a sector average. Here, strangely, we're not given a sector average, but please note, I would expect your examiner to always do so. He tends to be good that way. However, we are looking at liquidity ratios. And if we don't have a sector average, we can always fall back on the traditional accepted safe levels. If that's the case, we could say current ratio is safe on the basis that it is 2 or more. And the quick ratio is safe on the basis that it is 1 or more. If we're looking at the current ratio, 2 to 1 simply suggests this. Of the current assets, 2, half of them are funded by the current liabilities, and therefore the other half must be funded permanently. So looking back to our idea of funding, if we have more than half our current assets funded long term, that's considered safe. It's a funding issue. When we look at the quick ratio, it's far simpler than that. If the ratio is 1 or greater, that suggests that the liquid assets are greater than our current liabilities. That means that we are able to pay our bills as they fall due. So, if we're looking at our liquidity ratios, what can we say here? Well, just looking at the values in front of us, I think it's easy enough to suggest that things are getting slightly worse. Liquidity is falling. But if we were to compare them against conventionally safe norms, what can you say? Well, I would suggest that we are still safe. And as such, when we look at liquidity ratios, we are not over trading. And that's what I would write. Let's move on. Next, what we want to look at is our cash balance. If you wish, our net cash balance. Well, okay, let's see what we have. If we were to look at our cash balance, I suppose what we're getting at is this. In X2, last year, we had £1.5 million sloshing around in our bank account. Good stuff. Move on 1 year. We only have 100,000 sitting in our bank account, and more than that, we have an overdraft of 200,000. So, from that perspective, what can we say? Well, if we're looking at our net balance, couldn't we say 1.5 million minus 0.1 million? You know, the net of the two. Would that suggest to you that we are overtrading? Well, I think it is the most powerful suggestion that we're overtrading that we get. But my view is this. As a company, do you want this sort of money sitting around in your bank account? Well, the answer is no. Remember what we said before. Cash is an asset, and assets require funding. Therefore, if we have £1.5 million sitting in our bank account, earning no return, we still have to finance it, and that will cost us money. So what we could argue is this. All we've done is use up our surplus cash. And if you look at our overdraft, what was our overdraft here? Our overdraft was 200,000. Now, in relation to the bigger picture, you know, the amount of permanent funding we have, and the fact that we're a healthy, profitable business, is having a relatively small overdraft a problem? Well, my argument is no. So looking at this particular question, would the cash position suggest that we're overtrading? I think not. Although, of course, if we continue with this level of growth, it's possible that we may be overtrading in the future. Now let's look at our payable days. Remember, the length of time it takes for us to pay our suppliers could be a measure that we're having difficulty paying our suppliers. And that would be a key indicator that we're overtrading. So how do we calculate payable days? Well, we take payables over, well, if you remember, we want to take payables over purchases. But it's unlikely that you're going to have purchases in any question that you get at this level. So we divide through by the next best thing, the cost of sales, and multiply by 365. So let's look back at the numbers and see what information we're given. We have our payables, if you wish here, described as trade creditors. Notice, I'm only interested in the trade element. Other creditors are probably statutory creditors over which we have no choice. So we have our trade creditors, 1.5 and 2 million. And if we look above, we have the cost of sales to which they relate. So given those two pieces of information, we can establish our payable days. We said 1.5 million over 7 million multiplied by 365, and 2 million over 7 million multiplied by 365. So, how many days does this come to? Well, in the first instance, we get 78 days. In the second instance, we get 80 days. So what mind-bogglingly exciting things can we tell the examiner from this? Well, the first thing I would observe is simply this. Things haven't changed that much. Okay, they've eased by a couple of days, but does this suggest that we are having difficulty paying our bills as they fall due? The answer is, I don't think so. What else could we say? Well, my thoughts are this. If you look at the numbers, we're taking nearly 3 months to pay. And what could that suggest? Well, it may suggest that we're abusing our credit terms. We don't know because we don't know what the credit terms are. But I think it would be a useful thing to suggest to the examiner. So, my suggestion here is that we're not overtrading. Things haven't got progressively worse from last year to this. However, it appears that maybe as a matter of course we abuse our credit terms and pay everybody late. Okay. What I'm looking for are sensible things to say. What else could we have discussed here? Well, the only other thing that maybe we could have discussed just for fun is the level of activity. If we looked at the level of activity, I suppose we could look at sales. And if we look at sales, let's go back and look at the numbers. We see sales were 12 million, are 16 million. Wow. That's quite an interesting one. And maybe that's the starting point here. Because what could we say? Well, we've got 12 million here and 16 million here. Couldn't we simply say that the increase was 33%? I'm sure you can do that. And as a result of that, I would be inclined to be worried about overtrading. So, looking at the four things that we've assessed here. 1, sales make me worry that I may be overtrading. 2, liquidity ratios have declined. They have become less liquid, but they don't seem an issue. 3, cash balance. We've used up our surplus funding, but we don't have a seriously bad overdraft, given the nature of the business, its permanent funding and its profitability. And 4, payable days have not changed, although they look a bit high. If we can make those comments about these 4 ideas, we can easily score 8 or 9 marks here. For each computation you do, you're expecting a mark. And for each reasonable comment, you're expecting a further mark. Please be ready. Please stay narrow on a question like this. If you do that, you can score the marks. And as I say, it's not going to come up every time, this, but overtrading is the sort of question that we can expect to come up on occasion. If we know this, we can easily score the marks. Okay, what we want to look at now is how we manage receivables. Very much a popular topic with the examiner, and I think an area that we can easily score some lovely marks. You see, as with all of working capital, managing receivables is about a balancing act. On the one hand, why do we offer credit to our customers? Well, we offer credit to our customers to encourage them to take up our goods. You could argue, and I certainly would, that the reason why we offer credit to our customers is because everybody else does. Typically we have to, it is the industry norm. But the problem with offering credit to our customers is, well, manyfold. On the one hand, we may get bad debt. People don't pay us. Secondly, people may pay us late. And thirdly, we have to administer payment. If they pay us cash, we don't need a credit control function. As soon as we offer credit, we do need one. So we have to balance the need for receivables against the costs associated with receivables. Now, when we're looking at managing receivables, what we want to look at is, firstly, the management of them. And if we're looking at the management, what I would like to look at is the internal management and the external management. You know, the idea that we could do it in-house, or we could find some other way of managing receivables. In addition to that, we have to look at the cost of financing receivables. Now, of course, there are many components that may be included in here. But the big issue about the cost of financing receivables is simply this. Receivables are an asset, and as such, the asset requires financing, and financing costs money. So, we're looking at these basic areas. Let's start with the internal management. It's not difficult. but it is often a productive area for marks. So, when we look at management of receivables, I always want to separate it into three basic areas. The first area is what makes us decide whether someone deserves credit or not. Because credit is a privilege and not a right. So the first thing we have to do is to assess the credit status of our customer. Should we be offering them credit, or should we not be touching them with a barge pole? Secondly, what terms should we offer them? And thirdly, how should we act on a day-to-day basis to make sure that people pay their debts as they fall due? So, we look at credit status first of all. And all we look at here are the sort of things that we may check to make sure that we are happy to offer credit. We could look at their existing credit history. If they are already one of our customers, you know, how well have they paid in the past? Of course, we could go further and look at getting references. We could get a reference from a bank or from another supplier. It is convention when offering credit to a company to ask them for their bank details in order to get the bank reference and the details of 2 or 3 of their key suppliers. Bank references tend to be very bland and don't tell you that much. The simple fact that you get a reference off the bank is generally considered good enough and you file it away. Trade references, however, at least in some industries, are very, very important. They give you some depth and detail as to the sort of relationship between the company and its suppliers that you could possibly expect yourself. What else could we look at? Well, of course, we could look at the financial statements. They are out of date, so they won't really be very helpful to give you an understanding of the cash position, but at least they show that the company exists and they give you some indication of the relative size and importance of the company. Oh, and its asset backing. And of course, we could go to a credit rating agency. A credit rating agency, not surprisingly, could give a rating for the company, although most ratings tend to reflect more the needs of banks than, say, suppliers. They could check for CCJs. CCJs are county court judgments. These are judgments handed down by a judge in the event that there has been some conflict about payment. Now, if you get CCJs, this suggests one of two things, or maybe more things. It suggests either you're having difficulty paying and people are having to take you to court, or you're naturally an aggressive and quarrelsome company. And if that's the case, do people want to do business with you? So, when we look at whether we should offer credit or not, these are the sort of things that we may look at. Then we could look at terms. What are the terms of the credit that we offer? First of all, the number of days. And of course, the number of days that you offer for credit is normally reflective of the industry. It is quite normal in the UK to offer 30 days to pay, but some industries may offer up to 60 days or even longer. Of course, you may specifically attempt to encourage people to take your goods by offering extended credit. Although you could argue that if you do that, you are immediately running the risk of attracting the worst type of customers. So, we could also look at the overall credit limit. The overall credit limit is the amount that an individual customer is willing to run up as credit with you. Now, this is a very important measure. For example, if you're offering 30 days credit and you're expecting to, I don't know, do £50,000 worth of business with this customer a year, to make sure that you have a tight control over the amount of credit that they take, wouldn't it be sensible to say, well, if you've got 30 days credit, that's 1 month. Shouldn't we really only allow them a limit of maybe 1 month's credit, 50,000 divided by 12? In order to ensure that in the event that they don't pay their bills, we won't supply them, and that will force them to pay up. It's also the maximum amount we can expect to lose in the event that the customer goes bad. And of course, we could talk about interest on overdue account or discounts for early payments. So, we look at the sort of things that are in the contractual obligation. Finally, we look at day-to-day policy. Now, the issue with day-to-day policy is this. We have a difficult relationship to manage. Because the one thing we don't want to do as credit control is to upset our good quality customers. Because every single customer starts as a valued customer that we do not want to upset. But the longer the customer goes without paying, the less the valued customer they are, and the more they are a potential bad debt. And it's this gradual movement from valued customer to bad debt that we have to manage. So what we do is when we look at people not paying, we always have to first of all consider why. So if we were looking at day-to-day policy, maybe the first thing we do is give them a statement of account. Because there could be 101 different reasons why they haven't paid. Maybe we forgot to deliver the goods. Maybe we forgot to invoice them. Maybe the goods were faulty. Maybe they were delivered to the wrong address. All these sort of things are reasons why they haven't paid. So maybe by sending them a statement of account, we're simply suggesting this is what we think you owe us, you come back to us and discuss it. At this stage, we're very much at the valued customer stage. Of course, in the event that they don't come back to us, we start sending reminders. The first one, quite polite. The second one, slightly less polite. And maybe the third one, considerably less polite. After sending a couple or maybe even 3 reminders, what we want to do is to threaten something. Maybe we threaten legal action. Maybe we threaten to send the bailiffs round or something of that nature. And then finally, given that they still don't do anything, you must take action. You must take them to court. Or buy a big baseball bat. Or do something to encourage them to pay up. So, this sort of question has come up again and again in the exam. And my view is that if we can talk about this, which I don't think is difficult, and say a little bit about each area, we can very easily convince the examiner that we know what we're talking about. And remember, that is the basis of passing an exam. So, if we're looking at management of receivables, we've dealt with this aspect. Let's look at the other side to receivables. What we're talking about here is the cost of financing receivables. Now, of course, there could be lots of bits and pieces of cost floating around. But the issue with the cost of financing receivables is very simply this. We look at the receivables balance. The receivables balance is an asset, and that requires financing. So very simply, all we need to know is this. The interest cost equals the receivables balance multiplied by the interest rate. And quite often, the interest rate is given as the overdraft rate, which makes life simple. Now, given that we have this, of course, we don't always know the receivables balance. So what we may have to do is to rearrange. Do you remember the receivables days computation? If we make the receivables balance the subject of that formula, we could say that we take our sales multiplied by our receivable days over 365. And in simple terms, if we can pick up on what we see here, we have absolutely no problem dealing with this particular topic. Tell you what, should we just kick off with a few ideas and see how it works? So let's just put some very simple numbers up just for fun. So, if we have an example, sales are, what, $10 million? Receivables, 3 million. Oh, and our interest rate is 6%. Keep it nice and simple. Okay? So, what can we do with this? I suppose, to begin with, shall we just get our receivable days, which may or may not be required in any question? And also, shall we get the cost of financing receivables? And I'm hoping these are both very straightforward indeed. So, if we're looking at receivable days first of all, what do you think? Yes, it shouldn't be too difficult. Let's go away and play with the numbers. Receivable days. 3 million receivables divided through by sales, 10 million multiplied by 365. What does that come to? Well, okay, if you bash it out on your calculator, it comes to something like 109.5 days. Notice I've gone to decimal places here. That's because this number is normally just a working. That is an exact answer. If it wasn't, I would have gone to 2 or even 3 decimal places, because if you don't go to the decimal places, you're going to mess up somewhere. So we've got our receivable days, and all we want is the interest cost. And the interest cost couldn't be easier here. We're given the receivables balance. So couldn't we simply say, we've got a 3 million receivable balance, multiplied by the interest rate, 6%, and that comes to what? $180,000? So, as a result of having a receivables balance of 3 million, this is the cost, the very real cost to the business. Because every asset needs to be financed. Okay, so what we're looking to do here is to find some way of maybe reducing the overall financing cost. And we're going to see that there are 2 basic ways that we can look at it. One is to use a cash discount, or what I should really call an early settlement discount. And the other is to use something called factoring that we will talk about in a moment. So, let's first of all look at our cash discount. Or should I say, discount for early settlement. So, what impact is this going to have on the cost of financing receivables? Well, I suppose the deal is simply this. If we encourage people to pay early, our receivables balance will fall, because the number of days over which they pay will fall. And if the receivables balance falls, we would expect the interest cost to fall. So that's the benefit. Of course, there is the flip side. As a result of offering the discount, we're going to get less revenue because, of course, we forego that discount. So from that example, let's just think about how things may change. A 0.5% discount is offered to customers who offer to pay over 30 days. So it's hardly cash, but considerably sooner than the 109.5 days that we presently have. Yes? 40% of customers are expected to take up the offer. Okay, so a bit of fun here, nothing too dramatic. And all we want to do is exactly what we did before, but of course things are slightly more complicated. So we want to establish the cost of financing. The cost of financing our receivables. And to do this, well, you and I know that the one key computation here is the interest cost. There will be other bits, but if we can get the interest cost out, we're sorted. Now, there are lots of different ways of doing this, and I'm going to keep this very simple. Some of you will see that there are maybe shortcuts that we could take, and maybe we could just do the incremental analysis. But to avoid confusion, all I'm going to do each time is to establish the revised interest cost. Now, in this circumstance, there are two components. We have those people paying over existing terms, and I believe we have 60% of people doing that, and those people paying over discounted terms, and they are 40%. Yes? Now, we've got quite a lot of detail going on here. And what I'd like to do is just to remind us of how this works. Do you remember at the beginning I said that we may have to calculate the receivables balance? Well, that's what we're going to do here. You see, if we look at the existing terms, I think we could get the receivables balance very easily. But let's just make sure that we understand the relationship between sales and receivables balance. You see, we know that sales were 10 million, of which 60% or 0.6 are going to pay over existing terms. Now, what were the existing terms? Well, I seem to remember that we had what? 109.5 receivable days over 365. Remember, to get the receivables balance, we take the sales multiplied by receivable days over 365. Put those numbers into your calculator, and what do you get? Well, if you look at what you get 1.8 million. Let's just put it there, over here, out of the way. And what does that reflect? Well, yes, that reflects the receivables balance of those 60% of people who are paying over normal terms. And the only reason why I've done this is to make sure that you can check back and make sure that it makes sense. Because if we took 60% of 3 million, wouldn't you get 1.8 million? Okay. So, we didn't need to do it this time, but I did it just for fun. You see, when I look at any of these questions, I always want you to look at it in the same way. And that is, to get them right, I want you to focus on identifying the receivables balance. Because once you've got the receivables balance, all you have to do is to multiply up by the interest rate. And I seem to remember that the interest rate was 6%, although I could be wrong. So, receivables balance multiplied by interest rate. Receivable balance multiplied by interest rate. That's what we always do. Now, we've got our numbers out for those customers paying over existing terms. Now let's look at those customers paying over discounted terms. Remember, we focus first of all 10 million sales multiplied by 40%, those people paying over discounted terms. Multiplied by? Well, yes, first of all, what we want is our receivables balance. And we're suggesting that people here are paying over 30 days. So we multiply by 30 over 365. And once we've got that figure, our receivables balance, then we multiply by the interest rate. Again, if you wish, I focus on the receivables balance first. Multiplying by the interest rate is not going to be difficult. Well, okay. Now we've tidied up things. What do we come to? Well, the existing terms here, multiplied through, I believe comes to 108,000. If we multiply through the discounted terms, we get 19,726. So if we were just to focus on the interest cost, we see that the interest cost is 127,726. Now, before we go any further, let's just remind ourselves of what we calculated before. We said that if we used normal terms, we expected the cost to be 180,000. As a result of offering a cash discount, what do we find? The interest cost falls. Well, I'm hoping this is not rocket science to you. The single reason why the cost has fallen is because some people are paying over fewer days, and therefore the receivables balance has fallen. But of course, that is not the whole story, because when we look at this, in order for people to pay early, we have to offer them an incentive. And what was the incentive? Well, we offered them a discount, didn't we? So if we look at the discount cost, we know that sales were 10 million, 40% of which paid early. And what was the discount because they paid early? Well, the discount was 0.5%. So what does that mean? So we have a discount cost of 20,000, the amount that we forego. And we established that the total cost with the cash discount is 147,726. And what would the decision be? Well, yes, we can see that the overall cost of offering the discount is considerably lower than the cost that we had originally. And from that perspective, we would accept the cash discount. Now, whenever we look at this sort of thing, it's quite normal to then go further and look at the advantages and disadvantages of the cash discount. Now, I suppose the single advantage of the cash discount is that we get our money earlier. So if we need the cash, that's very important. But there are a series of concerns associated with early settlement discounts. Firstly, what level of discount should we offer? If the discount is not good enough, nobody takes it, and therefore we will not get anyone paying early. If it's too good, everybody takes it, but we lose too much money. So establishing the level of cash discount is quite difficult. I will say it's quite normal for some companies to offer a very generous cash discount because of their very real need for money. The second issue, a cash discount increases the degree of uncertainty with regard to when we receive our money. Receivables are already uncertain because people may pay late. But if we give them the choice of paying after one point or another, don't we even further increase the degree of uncertainty? What happens if everyone pays early? Maybe we've got more cash than we need. What happens if everyone pays late? Maybe we're in real trouble. Real trouble because we were expecting people to pay early and now we haven't got the cash that we were expecting. Thirdly, you could argue that a lot of companies are very cynical. When it comes to the cash discount, a lot of companies take the discount but still pay late. As a result, we lose. And what do? Do you go back to the customer and say, hold on, you owe me that amount of money? You know, that 1%, that 0.5%? Or do you think, they're a valued customer, I don't want to upset, and that sort of thing? So, early settlement discounts often come up in the exam. Be ready to do the numbers, but also be very ready to talk about advantages and disadvantages. Let's move on. What we now want to look at is debt factoring. Because debt factoring also could be incorporated in this sort of computational area. Before we do any of the numbers, however, let's just establish what debt factoring is. You see, the idea of debt factoring is that we outsource the credit control function. Instead of us collecting debt, we allow the debt factor to collect the debt on our behalf. Now, traditionally in the UK, debt factoring has had a pretty damaged reputation because debt factors were used in the main by failing companies. For example, if a company goes into liquidation, the insolvency practitioner who comes to run the company, their first phone call will be to a debt factor to collecting the debt. Having said that, debt factoring has become more popular as a source of finance and as a means of smaller companies to manage their credit control issues. There are three functions that a debt factor offers, and it is very normal for all three functions to be incorporated. First of all, they offer administration and debt collection. What happens is this. We make a sale and we pass the sale on to the factor for them to collect the debt. Secondly, they offer financing. In simple terms, instead of us receiving payment when the factor receives payment, they are willing to advance 80 or 85% of the monies immediately. And therefore, what we're doing here is receiving money before the point at which we would normally expect to receive it. You could say that it's a very useful short-term source of finance. It replaces short-term source of finance such as an overdraft. Of course, financing costs money, but it does have one key quality, and that is that it is off balance sheet. So it hides it from anybody analysing our balance sheet, the fact that we've borrowed the money. Finally, they offer credit insurance. In simple terms, in the event of a debt going bad, in this circumstance, the factor would take the hit. This is called no recourse factoring or without recourse factoring. And it sounds fantastic, doesn't it? What we could do is sell to any Tom, Dick or Harry, and then when the debt goes bad, they take the hit. Unfortunately, of course, debt factors weren't born yesterday. And because of that, if they are going to offer credit insurance, you know, in the event of bad debt they suffer, they will expect to determine to whom we are able to offer credit. And of course, I would expect their credit assessment to be considerably more rigorous than our credit assessment. So, when we look at factoring, these are the three basic areas that we could expect. And if you're asked ever to discuss factoring, you must discuss it in terms of these three areas. It makes it very easy indeed.